Okay, so a huge shift is happening in how the world's biggest companies get taxed, and Turkey is officially getting in on the action. We're going to break down this new global minimum tax, what it is, who it really affects, and why it is an absolute game changer for international business. Let's kick things off with this number, 750 million euros. Now, that's not a lottery prize or a government budget. It's a critical threshold. If a multinational corporation pulls in more than this in revenue, its whole world is about to change, especially when it comes to paying taxes in places like Turkey. So, what's so magical about that number? Why is it the trigger for such a massive change? To really get it, we first have to rewind and look at the huge problem that this new global tax was designed to fix in the first place. At its heart, this is all about lost tax revenue. For decades, governments have basically just watched as billions of dollars in potential tax income slipped right through their fingers. And it was all thanks to some very clever and completely legal accounting tricks. This problem has a fancy name, BEPS, which stands for base erosion and profit shifting. Sounds complex, right? But the idea is pretty simple. A giant company earns a ton of money in a country with a, let's say, 20% tax rate. But then it legally moves those profits to a subsidiary in a country with a 2% tax rate, or maybe even a 0% rate. They literally erode the tax base of the first country. And the result of all that? Well, you had some of the biggest companies in the world paying shockingly little tax on their gigantic profits. This meant countries like Turkey, where the profits were actually being made, were missing out on revenue that could have paid for things like new schools, better roads, and hospitals. So how in the world do you solve a problem that big? To fight back, the world's major economies basically got together and said, all right, enough is enough. They decided to team up and create a single, unified solution, a global minimum tax. This whole initiative was spearheaded by the OECD and the G20. Their goal was to put a stop to what's often called the race to the bottom. That's where countries keep undercutting each other with lower and lower tax rates just to attract these big companies. The idea was to finally establish a floor that no company could dip below. And that floor is this number right here, 15%. This is the new global standard. It's the absolute minimum effective tax rate that large multinational companies are expected to pay on their profits, no matter where on the planet they do business. But of course, a rule is only as good as your ability to enforce it. And that's where the top-up tax comes in, or ATV, as it's known in Turkey. Think of it like this. If a company's subsidiary is paying only 10% tax in country A, its home country, country B, can step in and collect the extra 5% to top it up to the 15% minimum. Just like that, the entire incentive to shift profits to a tax haven disappears. So that's the big global picture. Now let's zoom in and get specific. How exactly is Turkey putting these new rules into practice? The main tool in the toolbox is something called the Income Inclusion Rule, or IIR. If a parent company based in Turkey has a subsidiary in another country that's paying less than 15% tax, the Turkish government can collect that top-up tax directly from the parent company in Turkey. It's the first line of defense. But wait, what if the parent company is based in a country that isn't using the IIR rule? Well, they thought of that. That's where the backup plan comes in, the Undertaxed Payments Rule, or UTPR. This rule lets other countries where the company operates, including Turkey, to collect the top-up tax themselves. It basically ensures the tax gets paid one way or another. So, to put it really simply, the IIR is the main tool. It puts the responsibility right on the parent company's home country. The UTPR is the safety net. It empowers other countries to step in if the first rule can't be used. Together, they're designed to create a watertight system. The actual logic is pretty straightforward. Step 1, figure out what the company's effective tax rate is in a specific country. Step 2, compare that rate to the 15% minimum. And step 3, if it's lower, you apply the top-up tax on the difference. Simple in principle, right? Though I'm sure the accountants are having a field day with the nitty-gritty details. So, does this new tax apply to every single business out there? Not even close. The rules are actually very, very specific about who's covered, and just as important, who's not. And we are back to our big number. This law is aimed squarely at the giants of the corporate world, those multinational groups with consolidated revenues over 750 million euros a year for at least 2 of the last 4 years. This is not for your average small or medium-sized business. There's also a pretty clear list of who's out. We're talking about government entities, international organizations, nonprofits, pension funds, and some types of investment funds. They're generally excluded because the real focus here is on those huge for-profit commercial businesses.
Okay, so let's bring it all home. After all that, what does this really mean for Turkey? Why is this new law such a big deal for the Turkish economy?
The key takeaways here are huge. First, it protects Turkey's own tax base, making sure profits generated here get taxed at a minimum level. Second, and this is a big one, it levels the playing field. Local Turkish businesses can't shift their profits abroad, so they were competing with one hand tied behind their backs. This helps even things out. And finally, it brings Turkey in line with the new global standard, making its tax system more modern and predictable for everyone. You know, when you step back and look at it, you realize this isn't just some new tax rule. It's a fundamental shift in the rules of global commerce. The whole point is to create a system that's more equitable, where the biggest players pay their fair share no matter how many borders their business crosses. And that leaves us with the million-dollar question, doesn't it? Will this new global tax order actually make international competition fairer, or will the world's cleverest companies just find new, more creative loopholes? This is a massive step, for sure. But the age-old cat-and-mouse game between rule makers and rule benders, well, that's probably far from over.